And Stan, I want to ask you, in your opinion, is shorting riskier than trading long, or does it really depend on the overall environment?
Well, again, you're doing a good job. I think to a degree it does depend on the environment, but in reality, if we're going to be objective, it is a bit more risky, the long side trading, for a couple of reasons. But if we're disciplined, I truly believe you can take a lot of the risk out of short selling. First of all, just the fact that in theory, let's think about this. In theory, a stock can only fall to zero, which is bad enough. While again, in theory, a stock on the upside can go to infinity, so obviously there's a greater risk. But this is what a lot of people don't understand. If we're disciplined and we limit our risk, we say, where would we get out? And we always should. There's no way you should consider selling short without first defining where am I going to get out if I'm wrong. And by doing that, you also define what your risk is. And if you set a judicious buy stop, so you know you've defined where you're going to get out. If things go against us, we know just how much at worst we can lose. So we've already, before doing anything else, we've taken a good bit of the risk out of shorting. In the meantime, the second thing that makes shorting riskier and a bit more dangerous, especially for traders more so than long-term investors, is that when a stock becomes oversold, and it then turns around, and even on a short-term basis, jams higher, history shows that oversold bear market rallies, as well as oversold rallies in individual negative rated stocks as well as the overall market, are much sharper than declines in a bullish stage 2 stock. And there's a good reason for that, because as I've said many times over the years, there's no more motivated buyer than the short seller getting squeezed. So while traders for sure, and even investors in some degree, should trade around their good stage 4 short positions, when they become oversold, they start to rally, especially when the overall market is also starting to jam, it makes sense at times like this to do profit taking and to do some trimming in the short positions, so you won't be upset as they rally higher. And in fact, you'll almost be rooting for it so you can lay out shorts again at the appropriate times, because then when it rolls over and it fails at its designated area of resistance, it thereafter makes sense to put some chips back on the short side. And if you learn this discipline, not only will you rack up greater profits for sure, but you'll end up reaching much less for Malox, and you'll sleep a hell of a lot better at night.
And Stan, diving a little bit deeper into those risk management techniques, what are some important tools and processes that traders should use to protect their downside when they are shorting?
Okay, again, an important question. As I said before, first of all, before you even enter the short trade or investment, you should see where are you going to place the protective buy stop. If it goes against you, and even if it doesn't go against you, that's an important discipline, because you're defining what your risk is, and that's true, good discipline. Next, you should look to do shorting at ideal times, either when the stock is breaking down from stage 3 into stage 4, or as I said before, after it's had a sharp drop when it moves into stage 4, and then it has a sharp rally back up, and it fails near the breakdown level. Finally, it obviously also helps to limit risk if the overall market trend is with you, both short and longer term. And those are all factors that I think are very important to keep in mind as you check off the boxes.
Once a trader has a position on to the short side, when should they move down their buy stops or take profits when shorting?
There are actually a couple of answers to that question. First, investors should progressively lower their protected buy stops using a trailing stop technique, moving at least a third to a half of their buy stop each time above the prior peak that the market rallies and then fails. And assuming that the 50-day moving average is at a higher level, but it's declining, also moving the other half, if we did half on the other part, moving the other half of the buy stop above the 50-day moving average. That's for investors. Traders, however, should operate in a much more aggressive manner. And when the short is working and it gets smashed really nicely, but then becomes oversold and temporarily starts to hold, it's not an all or nothing game. Traders should immediately start to do some trimming. Thereafter, if you see a reversal day take place, and we've defined this before, that's defined as stock, makes a new reaction low early in the day and then reverses and either closes with a small loss or even worse from their trading point of view, actually closes up on the day, more trimming should be done. If it not only, this is another subtlety that most people don't know, if it not only closes, and we're talking trading wise, if it not only closes up on the day, but in addition, after making that new reaction low and it rallies and closes up on the day, if it closes above the high of the prior day, that's another big warning, a red light going off trading wise. If worse yet, if all this occurs on increased volume, the trader should lock in the rest of his profit with an eye toward reshorting down the road, but first getting out of the way.
And Stan, to kind of sum up the short selling section, what kind of general guidance do you have for traders and investors who want to improve their short selling?
First, we're going to answer that question, but I tell you, I really think this is so important that we delved and did a deep dig on short selling, because it's become one of the great bugaboos on the street that so many people won't sell short. They almost feel it's anti-American, and it's ridiculous. As I said before, because I always talk in analogous phrases, that if you don't sell short, it's like having a car that has no reverse on it, or tying yourself with your left hand behind you, so you're operating with one hand. It's ridiculous. But anyway, to answer your question, ideally, if a trader can check off the following boxes, that from a short-term point of view, the market isn't rallying, or it's had a short-term rally and it's running out of gas, and secondly, that your stock is either first breaking down from stage 3 into stage 4, or if it's already in stage 4, it's now having a rally back up and it's undergoing that failing rally that's running out of gas near anticipated resistance, and the stock, like I've said before, is part of a weak group. Boom, boom, boom. These are all boxes to check off. I think then the trader has all of the odds in his or her favor.